Morning, everyone. I think some of you were probably with us 12 months ago. So last year we did a presentation on, and it was entitled UK Mortgage Market 2023, Headwinds and Tailwinds. So after a great deal of thought, we thought we'd name this year's UK Mortgage Market 2024, Headwinds and Tailwinds. And I think it's good news that there are probably more tailwinds than headwinds now, even 12 months on. So just a summary of the learning objectives of what we're going to be talking about today. So we'll have a look at the current economic situation, what the future may look like, what it's been like so far this year. I should point out that I am not an economist, so Neil built me up as if I was one. We do have an economist that works for us who is generally quite positive, actually. He's always a glass half full. And I was looking through the presentation we did last year, and actually a lot of what he said came true, or even is better than he forecast. But so we'll look at a couple of bits. We won't sort of kill you with science around the economy, but just a few things to pick out. The impact of those on the mortgage market generally, and then some of the opportunities, some of the challenges, because there are still plenty of challenges, and how how specialist lenders can help you, hopefully with those sort of opportunities. So just a quick reminder of who we are, OSB Group. So they're our main brands, Precise, Kent Reliance and Interbay. We're a specialist lender. There are a number of lenders here today that are going to, present roundtables to you. They've all got their niches. Really listen carefully, and hopefully there's some nuggets in there, because we operate so that we exist so that we can help with those cases that just fall through the cracks of the mainstream. And there are more and more of those sort of situations, those type of clients that do need that sort of help. So, we'll be doing a roundtable. My colleague Haley will be doing roundtables, but also there are other lenders as well that, equally have plenty to say, and hopefully plenty of assistance for you. So I think it's safe to say that it's been a very challenging environment in the market, both for lenders and for advisors. Over the last few years, really, you go back to Brexit, and then we've had COVID, and we've had all these other barriers or challenges that we face both in the residential market and the buy-to-let market. We're constantly adapting. Lenders are having to adapt, and you're having to adapt. And it's sort of, I was trying to think of a football analogy to use. I was thinking of Manchester City. Manchester City have won the Premier League 4 years in a row, but they never stand still. They're always changing. They're always bringing in new players. They're always trying to change to keep at the top. And I think that's that sort of reminded me how they adapt, and how we've needed to adapt both as lenders and advisors. I was going to use my own team, West Ham, but I thought that might be stretching it, talking about league football, so I use Man City instead. But every challenge creates an opportunity. So hopefully we can highlight a few areas that might be of interest to you. If we look at the economy, so you can see there, 2022, 2023 GDP. So the growth in the economy was pretty flat. In fact, the last 3 months of last year, there was a lot of discussion around, are we going into a technical recession, because growth was negative at the end of 2023. But we bounced back pretty quickly as a country. In fact, it surprised most economists that we bounced back in the first half of 2024. And actually, the UK economy grew quicker than most leading European nations. And even at one point was on America's coattails. So it's bounced back quickly. I think the forecast is that this year GDP will be around 1.5%, and then rising to 2% in 2025. And the reason for that is obviously inflation has fallen dramatically. So inflation really stagnated the economy, and of course high cost of borrowing in the mortgage market, and big household budgets were under pressure. So that's why the economy was suffering. But we're coming through the other side of that. Interestingly, a year ago, our economists said that they forecast GDP in 2024 to be 1%. Now they're saying actually 1.5%. The Monetary Policy Committee report in August was actually a bit more conservative. They were saying, maybe 0.3, 0.4% growth in the rest of this year. But our economists are saying, actually, people have got more money now because they're paying lower taxes, because obviously national insurance has been reduced. Energy prices have fallen dramatically, so they've got more money in their bank accounts, and household cash flow has improved quite drastically. So there's the sort of things that drive the economy moving forward. If you look at inflation, and this is obviously the key driver really. So inflation averaged last year 7.25%. This time last year, if I was standing here, inflation was standing at 5.9%. So it reached its target of 2% in May. It's bumped around a little bit. In July, it was 2.2%. I think there are a few bumps in the road to come the rest of this year because you've got the energy price cap going up in October, so that could have an impact. So we might see a few small rises, but generally around the sort of area that the Bank of England are comfortable with. And there are two areas of inflation and all the different inflationary measures that the Bank of England are concerned around. One is wage growth, which in the first 3 months of this year was 7.25%. You can see here from the slide down to 5% in the 3 months to May. And actually the figures that came out yesterday, it was 4% in the 3 months to July. So wage inflation is reducing, which is a comfort to the Bank of England, which is probably why they quite surprisingly put bank base rate down in August. The other area of inflation that they're just a little bit concerned around is services inflation. So services and goods inflation are the measure of, obviously, goods and services. Services are things like what we spend in pubs, restaurants, hotels, going on holiday. That's been quite sticky, but clearly they were comfortable enough to put rates down because wage growth has started to fall. So the next meeting, the Bank of England, is next week on the 19th. It's probably unlikely that they'll cut base rate in September, although that might change. You can never tell. But I think we're expecting at least one base rate cut by the end of the year. Probably more likely November at the moment. But generally lower taxes, lower energy bills. There's more money in people's pockets. They go out and spend that money. So they're all good indicators for the economy and GDP moving forward. The housing market, which is the one we're interested in, isn't it? Let's be honest. So this is a lot more positive. So this time last year, this slide had a slightly different squiggly line. Sales had gone down by 21%. So they're now, you can see they're increasing sales agreed 13%. The average decrease in average sales price exchange, that's new to me, that shouldn't be there. But house prices roughly have gone up, I think 2.75%. A year ago, they'd fallen 3% year on year. So house prices going up. But there's a lot more activity now, and I'm sure you've seen that. And I think the cut in the base rate in August probably triggered that because it just changes people's sentiment. Now people who have been sitting on the sidelines thinking, am I going to move? Is it the right time to move? Suddenly they see the headlines, base rate's gone down, great, mortgage rates are coming down. And obviously the domino effect of swap rates coming down, the cost of lending has come down. So that's all good. You see the number of instructions increasing, the number of transactions increasing, the number of searches on property portals increasing. So it's all good news. How does all this translate to base rate? So swap rates have come down, which is obviously the cost of funding for lenders. At the moment, bank base rate is around 3% higher than the inflationary rate. That's the biggest gap there's been since before the financial crisis. So you can expect, there is wiggle room there, and you can expect that to close. Not completely. I don't think we're going back to 2% base rate, but probably somewhere around 3.5% eventually. But of course, there are lots of outside factors that can affect that. But I think the message going forward is things are looking a lot better than they were 12 months ago. However, there have been impacts on the cost of living crisis, higher energy bills, etc. And you can see here, so this is a slide on adverse credit. So the amount of CCJs registered in the UK. So the amount of CCJs registered per working day, 3,765. That's actually lower than this time last year. So it was around 4,000 a day last year. That's still an awful lot of people. 233,000 people in one quarter. So that's nearly 1 million people a year that are getting adverse credit that won't find their way to a specialist lender without your help, because they won't be able to wander down the high street and get a mortgage. They won't have heard of Kent Reliance or Precise or most of the other specialist lenders. So that's a real opportunity there if those people walk through your door or about them, because you can turn them into prime lenders, prime borrowers. If they keep their nose clean. So although the number of CCJs have gone down, the value of those CCJs has gone up slightly. So it's gone up 6%. You can see the amount of personal debt owed, which has gone up £20 billion year on year. I'd like to say I've made a small contribution to that, which if anyone is taking their family on holiday in August will attest to. All I say is thank God for 0% credit card transfers. But in all honesty, whilst the cost of living crisis has eased, there's still a lot of people that need that help, and that's where specialist lenders can come in. So those with adverse credit, but these are just some of the other areas, and I think some of the lenders here today will be talking about some of the solutions for these areas that are underserved by the mainstream lenders. Self-employed, for example. If you've got someone who's only been trading 12 months, they're probably not going to get a mortgage in the high street. Maybe one or two lenders, but the criteria will be very strict. That's a cornerstone of what a lot of specialist lenders do. That's the number one reason people go to a specialist lender for residential mortgages, actually for self-employed, not for adverse credit, believe it or not. Although, that's the perception. Issues around affordability, looking at lenders who don't credit score, looking at lenders who manually underwrite the old-fashioned way. All that. There's never been a greater need for that in the market, and that's where lenders like ourselves and say other lenders can really help you. So there are solutions out there. We move on from the residential market to the buy-to-let market, and how are landlords? Any landlords any buy-to-let landlords in the audience today? How are you feeling? Positive, negative, indifferent? Yeah, negative. Yeah, that would probably be borne out by this graph, actually. I'm not going to dress it up any other way. It's been very challenging for landlords. This is a survey that's done by Pegasus every quarter. So they interview 750 landlords of varying sizes, portfolio size, that is, not BMI. So you can see here. So you got 3 lines here. So you can see, the bottom line is their confidence in the UK economy. You're not a confident lot when it comes to the UK economy. I have to say this was taken prior to the bank base rate reduction, this survey, so it may change slightly. So not particularly confident about the economy. Rental yields, actually, surprisingly, 36% of those surveyed are confident in the rental yields, which is I'll go on to in a minute, which is quite surprising, actually. But then the confidence in the overall letting business is actually highest it's been for a couple of years. And what we're finding is that landlords are changing behaviour. So they're not, the landlord that will go and buy a standard buy-to-let property, it's unless you've got a really big deposit, there's a lot of barriers to that. It can be quite hard work. So we're seeing them diversify into other areas, other types of properties, looking at the type of locations they buy in, etc. So yeah, as I say, it was quite surprising because 85% of those say that they're making a profit. So that those rental yields are 86% landlords report tenant demand is stronger than ever. So you sort of think, well, that must mean that in a market where there's not enough supply and there's over demand, you'd think that they'd be more confident in that factor. 74% of landlords are seeing increasing rents, which is three times more than we're saying that 4 years ago. So and it's profitability is largely stable. So with over 85% say that they're making a profit. But as I say, I think it's just the way landlords that are buying are changing their behaviours. So how do they do? How do they reach profitability? How do they get on that road to profitability? So as I mentioned, they're looking at the types of property they're buying. So we're seeing a lot more demand for HMOs, houses in multiple occupation. We're seeing a lot more demand for multi-unit freehold blocks. We're seeing a lot more limited company structures, of course. It's much more tax efficient, especially if you've got a portfolio. So there are landlords out there that still need that advice, but they're diversifying. They're looking at other ways to add value to their portfolio. You'll see here that the reaching profitability. So the average yield. So the most profitable tenants are actually students, and that's not surprising, because UCAS are saying that by 2030 they'll be processing 1 million student applications per year, which is up a third on where it is at the moment. Universities can't build enough student accommodation. So, if you're buying in a university town or buying maybe near a major transport hub or a major employer like a hospital, blue worker, manual workers, they're the higher yielding type of tenants. And then no surprise is that the most profitable types of properties are multi-unit flats, HMOs, and we're seeing landlords trying to look for those types of property or maybe convert them. Seeing those opportunities, and we've had to change. We've had to change our criteria around HMOs and multi-unit blocks. when I joined OSB nearly 9 years ago, we would lend up to an 8-bed HMO. Then we went to a maximum of 10. Now we'll do 20. So 20-bed HMOs, 20-unit, multi-unit blocks. We've also had to look at the way we value some of these properties, because we're seeing more and more what are known as hybrid properties. So this is an HMO where, it's not just a standard 5-bed house with 5 tenants in. This is a property where each room has its ensuite, for the more discerning tenant. But they don't, a normal bricks and mortar valuation doesn't really do it justice. So we're having to instruct commercial valuations, investment valuations, to get the investment value of that property, which works much better for landlords on the whole. And that's the sort of thing that they've been asking for. So that's the way we've had to adapt to that market, which is growing all the time. This is the same survey, by the way. This is almost a sort of stating the bleeding obvious survey, but potential rental yield is the most desired attribute when a landlord is buying a property, which doesn't surprise you. What did surprise me a little bit is that overall capital gains potential has got the same percentage as suitability for couples. So I'm not really sure why that is, but that second one, potential for adding value, that's what we're seeing. We're seeing landlords buying a property that needs a bit of work doing to it. So they might buy at auction, they might renovate that property to make it suitable for letting. They might turn it into an HMO if it's big enough. They may turn it into turn a big old house into self-contained flats. That's where we're seeing the real growth in buy-to-let. And one of the solutions to that is bridging. And I know bridging is often a dirty word, and I might, if I haven't lost the room already, I might by talking about bridging. But it is a growing market, and it is a real solution and helping landlords in their aspirations. And you can see there's a big increase in the amount of bridging. It's the average rate is 0.86 a month, which is expensive. It's more expensive than a normal buy-to-let, but it enables landlords to do what they want to do, investors to do what they want to do. And actually our rates start from 0.69. But you're not going to get a client walk into your office and say, I want a bridging loan. It's the sort of solution that's there and available. And actually the pricing hasn't really changed in if you go back 3 years, buy-to-let rates are probably nearly double where they were, whereas bridging has stayed pretty much the same. But it needs a sell, because a lot of clients will say that's really expensive, 0.86 a month, because I'll get an illustration over 2 years. God, that's a lot of money I've got to pay back. The average lifespan of a bridging loan is 6 to 8 months, but actually it provides the solution. So in the great scheme of things, it's an option that's worthwhile. You might not do bridging, you might not have the permission from your network to do bridging, but there should be someone you can refer to that will help. A lot of the packages will help you with that. But actually, talking about landlords, and this is one solution for them, chain breaks is still the biggest reason that people use bridging. So if you've got links to estate agents, tell the estate agents about it. If they're in danger of losing a chain, tell them that there is that option, which might work out cheaper than losing a client and losing a potential buyer and having to start all over again. So it's just something to think about. We'll talk about bridging. I think bridging will become more and more prevalent in the market, but it's just something to bear in mind as a way of helping that client who may well need a residential mortgage as well in the future. So just food for thought. Refurbishment buy-to-let. So we've got a product. There are other products available, and this is almost an entry-level bridging product where it will enable that landlord to buy that property that needs some work doing to it. It needs a light refurb. It enables them to buy. So it's bridging and a buy-to-let all in one, basically. The bridging, the first loan, will get them the opportunity to buy that property, get the work done, re-inspection. They then go on to a normal buy-to-let, because one of the big risks with bridging is, what's my exit strategy? What's the rate going to be in 6 months or whatever? Well, this is all built in, so you know what that buy-to-let rate will be at the end once you've done the work, once you've paid off that bridging. So again, something to think about as an option. But we're seeing landlords using this type of scenario more and more. Now, thank you very much for your time. This is just a motivational slide to get you all, enthusiastic about what we've spoken about. But, I'm not going to patronise you by going through word for word, and I certainly didn't write it. But it's just all about, we're continually having to adapt our behaviours, and both as lenders and advisors, and that there are still so many opportunities, if you look outside maybe the normal realm of what you do. So thank you very much for your time, and I will hand back to Neil. Thank you.